The best day trading strategies are usually the ones that are quite simple. So in this video, I will show you my favorite candlestick strategies. I will show you the right entry, how to analyze the chart, where to get out, and provide a lot of tips that you can use for your price action and candlestick day trading. So we are starting here with the Engulfing Follow Up strategy, and it's a very, very powerful tool. You can see it soon. So what we have here on our higher time frame, we're starting on a 4-hour, and then we will go down as low as the 5-minute time frame, but you can also use those on the 1 hour. So what we have here is great context. We are in a long, mature downtrend, and then we are seeing here a engulfing candle. But before the engulfing candle, an inside candle. So we have a very strong bearish candle. Then the momentum pauses with the inside candle, and then we have our engulfing candle. At this point, we have a bullish bias. At this point, we're going to go to a lower time frame. It doesn't mean we're automatically going to go long here, but it's our starting point. And this is how I use higher time frames in my trading to help me filter out the good and the bad markets. Also, when we zoom out, what we see here is that we are trading into a previous demand area. By the way, I'm leaving a link to our supply and demand trading view indicator below the video. So we can see that here is a very strong demand area, and the engulfing candle happens right at the supply and demand area. So that's a great confluence. And at this point, let's go to a lower time frame. So we are here on the 5-minute time frame, and on the 5-minute time frame, the engulfing and the inside candle look like this on a microstructure. So what we have here is the deep initial push. Then the market made an ultimate low, which the market was never able to come close to again. At the same time, we have here our resistance level. We have also here, very, very important, a higher low. This is the key, because the market, when the market makes a higher low in such a context, also in the higher time frame context, it shows you already that there is more buying power coming in. And then we are seeing here a bullish breakout. We also have, once we turn on our daily pivot points, you can see we are trading below the daily pivot point. I made a few videos recently about the importance of pivot points. So I would always recommend to wait for the market to trade above a pivot point, especially for a day trader. You want to make sure that if you're long, you are above the central daily pivot point. A few candles later, this is what happens. And you can see the market trades above the central pivot point, breaks out of it here, and comes back for a retest. So a break and retest approach is very powerful. And by this point, you can see that the market is now on its way in a new bullish potential trend. We're making higher highs and higher lows. So our trading plan in this case would be to wait for the market to make another push. This is what we will call a corrective phase or corrective wave. The market is always moving in those waves. It's going back and forth, back and forth. And in an uptrend, we call those impulsive waves that go into the direction of the trend. And we call them corrective waves, which are going sideways. And we never want to trade into a corrective wave. We want to make sure that we're going with the momentum. And you go with the momentum when the market actually breaks out. And you can see a few candles later, we have what I call a lower bounce. Some traders may refer to this as a breakout buildup. So the market is keeping trading below this resistance level. It's a very, very well-defined resistance level. And what we see underneath the resistance level is a buildup. The market is trading into the level with higher lows. Very, very key point and very important piece to the puzzle. So at this point, we have clearly established that the market is trading above the central pivot point. We have come out of our accumulation phase. We are moving away from our higher time frame engulfing candle. All we have to do is wait for the market get out of it, and there's a high likelihood that we're going to look at a potential uptrend. And that's what happens. You can see on the breakout buildup, there's a lot of steam building. The market is trading in this tight congestion. And on the breakout, this is what you will often see. The market is really exploding away. The longer such a pattern takes to break out of, and also the tighter the lower bounce is, very often the stronger the breakout that is happening afterwards. Let's look at another example of deceleration and the combination with demand zones, because demand zones are really, really powerful. That's where a lot of trading is happening, and we can use that to our advantage. Again, we are looking for our 3-candle reversal pattern. We have a long bearish candle, we have our inside candle, deceleration, and we have the strong momentum candle. By the way, here we had a previous example. We have a strong bearish candle, and inside with a deceleration candle, a strong bullish candle, and then you can see the market rallied higher. So this could have been your clue for the previous trade, but now we're looking at this example. And if we turn on our supply and demand indicator, again, the link to that is in the description below. You can see that the indicator picked up here the demand area, and that is where the market has really shot up from. So at this point, we have some great confluence. We know the market is in an Elliott wave that is completed. 1, 2, 3, 4, 5. So we have 5 trend waves, a completed Elliott wave. We have our candlestick pattern here that is showing us a reversal, and we have the support of our demand area. So at this point, we have a lot of positive confluence that will help us to shift towards a bullish bias. Now we go to a lower time frame. We turn on our pivot points and the round number again. So we have the round number of 104, which is right here, and we have our pivot point. First of all, it's already great that we are trading above the pivot point. In an uptrend, you want to trade above a pivot point. That's really important. By the way, this is the 5-minute time frame for everybody wondering. So we are trading above the pivot point, and this is key. In an uptrend, you want to trade above pivot points. And here we have a pattern. So the market is always going in those waves. And the good thing is we can wait for those corrective waves. And once the market clears this area here, above the high and also above the round number, this is where you then look for bullish continuation trades. So what you see here is the breakout or around the round number. Here is where we have the liquidity run. If you don't know what a liquidity run is, make sure to watch my last day trading video where I talked about specifically the strategy about the liquidity run. And this is where the market is fishing for stops. It moves higher back into the highs. And our trading plan is now we wait for the market to get above the highs. We want to make sure we clear this area. And that is then where we expect the market to really take off. And that's what happens. You can see the market breaks above it, retests it, takes off, comes back to the zone, retests it another time, and takes off. So there's a lot of great things here to learn. First of all, on the higher time frame, we look for different confluence. We want to have a candlestick, we want to have a structural support, and also we want to make sure that it makes sense in this trend context. So in this context, we have a completed Elliott wave, so it makes sense to look for longs and not only for shorts anymore. Then we go to the lower time frame where we want to make sure we time our trade with the microstructure of the lower time frame. In this case, we want to make sure we trade a breakout above the highs, above the round number, after liquidity run, and that is then how we can design our trading strategy. So this is one of my favorite, if not my absolute favorite candlestick pattern. It's so powerful, and you can make a trading career just out of this candlestick pattern. And it is, as the name suggests, a 3 candlestick pattern, so we need 3 candlesticks. And what you will see is often after a strong trending market, you will have a strong bearish candle, then an inside candle. The inside candle can also have maybe a pin bar, a wick, and then the next candle has to be a strong momentum candle away from it. So this is a very, very strong reversal signal, especially in the right context. And what this pattern does, it gives you a higher time frame bias. So we are here on a daily time frame, and if you see something like that on the higher time frame, maybe even as I shown you in the previous example, in a support resistance, supply and demand area, after a long mature downtrend, maybe in a divergence, this can be your clue to drop to a lower time frame and then look for trading opportunities away from this pattern. On the lower time frame, this is what it looks like. At first glance, obviously, we don't see much. There's a lot going on, but we can add more confluence here. So we add our round number indicator, and this is 0.69. Also, we have here our traditional weekly pivot point. So very, very important level and clustering right here. So this helps us already to have a little bit more structure. Waiting a little bit longer, we have starting to see now some trading behavior around the level. So it is very important. As a day trader, you don't need to be super fast. We are here on the 5-minute time frame, so you'll get lots and lots of candles in a single day. So when you see such a pattern on the higher time frame, you don't have to trade right away. You have the luxury to wait for many, many candles. And what you should always do is wait for a pattern to emerge on the lower time frames. Patterns are just so powerful, and they're really going to help you improve your trading approach significantly. So what we have here is now a breakout approach. The market is clearing this cluster of the round number, the cluster of the weekly pivot point. We are also breaking through the last swing highs. So in the uptrend, the market made those highs. We have here a potential corrective wave. We also see here signs of an inverse head and shoulder. And then we have our breakout. If you have watched my previous video where I talked about liquidity runs, if you're taking a breakout approach, you're probably going to have your stop loss here or maybe somewhere in this vicinity. So if you are looking for a stop loss placement or a stop loss movement, don't move your stop loss too close to break even too soon. And if you are a trader who is looking for a liquidity run, this could be a zone where you could look for a liquidity run into. You can see afterwards the market really traded higher, and it traded higher until we hit the next round number here. So the analysis starts on the higher time frame. You wait for your clue on the higher time frame. You drop down to your lower time frame. You look for patterns, you look for levels, and those patterns and levels will help you determine a trading plan. The trading plan is you wait for the market to get out of such a corrective phase. You really want to make sure if you're trading long that you're going with the momentum, with higher highs, with lower lows. And this happens here on the breakout. And then you can just let the market unfold. As long as the market is making higher highs and higher lows, we are looking at a healthy uptrend, and you could have taken profits here at the previous round number. Last but certainly not least, we're talking about rig rejection. And this is something that is really common. It's a very great pattern to note. And on the lower or on a higher time frame, this is how it looks like. What you will often see is that you have a cluster of candlesticks that have all wicks poking into the same direction. So you can see we are here 1, 2, 3, 4 candlesticks with very long wicks into the downside. So each wick represents, or each candlestick is 1 day. So within that day, the market tried to push lower and was rejected higher, tried to push lower and closed higher, tried to push lower, closed higher. So there's a lot of position building going on. A lot of sellers wanted to move lower, but there was not a lot of selling pressure. The buyers came in every time to keep pushing the price higher. So a lot of big players probably took the position here. On the lower time frame, we are looking for structures. What we see here is a huge accumulation pattern. We have a triple low. We also have a nice trend line here to the upside. We have our regular break and retest approach. So you can see on the breakout out of the trend line above the recent high, the market makes a push, comes back for a pullback trade, rallies higher, and this level is respected another time. If we zoom in here, you can very nicely see that there is here a flag pattern. You can also very nicely see you could have used that for a breakout approach. So are then many ways how you can use that. In general, what you want to see is the higher time frame gives you the direction. If we see something like that, we know that the bearish side is not super strong and the bullish side is really ready to explode higher. Then we know and we use that knowledge on the lower time frame to look for breakout and pullback trades where they make sense. Just because the higher time frame is giving us an idea that something is likely to happen, it doesn't mean on the lower time frame we will jump on it. On the lower time frame, we really still have to make sure that we are following proper trading principles. So breakouts, we look for flags. We want to see that the market is trading out over the accumulation. We want to see that the market is pulling back in certain levels. We want to see momentum, and that this is how we then use the higher and the lower time frame together in a day trading strategy.